that, what has building up this cash, this free cash flow that you are accumulating, you are making money now. You're making a lot of money now, right? Nice, right? It's always nice. But it's giving you optionality, right? So you've talked previously about the ore sorter and bringing that in terms of improving productivity. What are the other things that it's allowing you to do now? And what are the things that, just in your head, that you're thinking, well, what's it going to allow us to do in the future? Because money brings options.
So look, let's just talk about the cash first, and I'll talk about the exploration side. In Q1, we managed to increase our cash position to $38.4 million Canadian. What was that? Probably around $4 to $5 million increase from Q4. And that, look, this is an important part here. That is despite paying into $5.3 million into hedges. These were legacy hedges that were put in place to reduce dilution when the mill was bought, Matt. So the hedges make sense why they were put in place for the debt. Now, we had 7,500 ounces of hedges in Q1, which cost us $5.3 million. You add that into what we actually added to our treasury, you're close to $9 to $10 million of free cash flow in Q1. That's an impressive quarter. Now, where do we go from here? Q2, we burn off those hedges. We believe wholeheartedly that people are investing in us. In fact, we're hearing it. People are telling us, look, Paul Huet, don't hedge. I believe gold is going somewhere else. And look, I've been in gold 30 years. I also believe gold is not capped yet. I think there's an unlimited amount to where gold can become here in the next year or so. So Q2, we will have no more hedges. We've got about 3,500 ounces left, Matt. 3,500 ounces. We had 7,500 we placed in Q1. It's easy math. It's 2,500 ounces per month. That's what we were doing. So once these 3,500 ounces are gone, our hedges are gone. We're selling at the open market. Now, what do we do about it? Well, let's face it. We are in a district that hasn't had much exploration in almost 2 decades. We've been talking about it. We've managed to reduce that Morgan Stanley royalty. We've always said, if we can do some work on these royalties, we're going to change these locations of mines. We are in an area 1,800 square kilometers. Within 4 months, we've identified 5 new areas at HGO within that 1,800 square kilometers. So extra cash will add drilling. We believe organic growth is certainly something that's doable for us. But certainly having extra cash opens up a lot of opportunities. And look, of the 5, I'll talk about Fairplay North, which has been very instrumental to us generating the stockpile. I'll talk about Aquarius. Aquarius is just south of the mill. The Trident mine was what the mill was built for. It produced 1 million ounces, Matt. We've got a resource directly south, 5 kilometers south of our mill. It's called Aquarius. This thing is wide open. We have intercepts of 600 gram, 200 gram across 2 meters. We've drilled some holes into that. So some of that money you're saying, well, what do you do with cash? There's no doubt that us putting money back into the ground, reinvesting into ourselves, paying off our debt, will really create shareholder value.